All right, so once again, inventory, right? We know what merchandising inventory is, right? Because the whole purpose of this class is we're focusing on primarily being a merchandising company, right? Therefore, we're going to make purchases of inventory. We're going to convert that into cash and then or purchase it with cash, create the goods, then we're going to sell those goods to get ultimately cash, okay? So here we're spending money in order to generate money, all right? And we would usually buy it at a lower price to sell it for a higher price, okay? That's just usually how, generally how retail stores and wholesale stores actually operate, right? They buy cheap or they buy in bulk, and then they just sell it out to the public for a higher price. So once again, we're looking primarily at a merchandising store or its type of business activity. So that's why we need to be introduced into inventory. Now, once again, what is included in inventory? So this is where that very important that you understand that when we have inventory, the purpose to calculate your total cost to sell an inventory is to include every single expense it takes to get the asset to the store. So if you had to purchase the items, right? They charge you sales tax, that's going to be included. They charge you shipping and handling, that's going to be included. Let's say you expedited it, right? You needed that so badly, so you paid extra to get that stuff to you within the next day. Or if you purchase it from foreign countries, right? Most of our goods, right? They're shipped from overseas, right? Anything that gets the inventory to your store is going to be included into the cost of goods, into the cost of inventory, okay? So again, but for this class, we're only focusing on two, right? We're only focusing on the selling price and freight, okay? I want to keep it very simple because if I introduce all these things, it's going to just make it more complicated. So all I need you guys to know for this class, particularly when we're doing our journals, I only want you to recognize two things unless I specify it. But I'm not going to test you on, what happens if I got taxed, or what happens if I had to pay additional fees on stuff. No, I'm only going to be really, really simple. But just know that these things are included as part of the cost of goods, okay? As part of getting your inventory to your store. Again, we're going to talk about shipping, right? We have to know that what shipping destination is and shipping origination. So again, shipping origination, or also known as shipping point, is usually when the items are from the seller store and it's making its way to the midpoint, right? Once it gets to the midpoint and then it makes it to your store, then that's called shipping destination, right? So how this works is, this is also the difference between when the ownership is passed along. So from shipping point, right, from the seller store to the midpoint, right, it's the owner's. It's the seller's property, okay? The minute it leaves that midpoint and makes it to your store, you're the owner of the property, okay? So remember, ownership of transferring from the seller to the buyer, which is you, right? If you're purchasing the items, you technically don't claim ownership until it is at your store, okay? This also applies to who pays for what, right? So the buyer is responsible to pay the shipping point from the store to the midpoint, okay? You are responsible to pay the shipping to get it on the truck, okay? Then once it hits the midpoint, the seller is responsible to pay the shipping between the midpoint all the way till it reaches your store. And that's exactly why a lot of times, right, Amazon packages, right, you say, I never received my items, someone stole it, right, or it just never came to my house. Who's responsible for it? Who's the one who had to pay the shipping between the midpoint into your store? The seller was. So that's why the seller is going to take full responsibility and be like, oh my gosh, I'm so sorry. Let me send you either a new product or let me refund you your money. Okay? However, the ownership is still, it's still your property because it left the midpoint and it's trying to make its way to you. So technically, you own that product, right? But it never came to your store. So that's just that right there. Just a little thing that you need to know here. But one thing that I want you guys to also know is the two different types of shipping methods, right? We have FOB shipping and we have COD. FOB just simply stands for freight on board. Usually this, when a company has FOB, they have their own individual shipping company, okay? The company that you purchase the items from, they have a small section that even ships it out to you. COD, which is cash on delivery, typically when the company uses a third-party vendor that has no association with the company whatsoever. They're just a simple delivery company. Then that they usually typically charge cash on delivery, okay? Because they have nothing to do with that particular company, right? It's a third party. All they're responsible is to just ship the items to you. So they are going to charge their own different cost, okay? All right, so inventory tracking methods, right? We learned what periodic is and we learned what perpetual is, okay? We know that periodic is every once in a while. A big notion is that at the end of any given period, typically you would have someone run down to the basement, warehouse, whatever it is, to take a physical count of your inventory, right? That is usually what periodic does. They don't keep track every single day. They don't count for what has been sold. They just assume that once they can take a physical count of their inventory, they must have sold the rest, okay? And usually a big key factor here is that once we purchase periodic inventory, we recognize it as an expense. And then at the end of the given period, once we take that physical account, then we convert the periodic inventory or the purchase expense, right, into inventory. Whereas perpetual, right, we're constantly updating our inventory, right? That's exactly what perpetual means. It means constantly. When we deal with this kind of inventory, right, we're keeping track of everything that comes in to the store and everything that goes out from the store. So every sales make a difference, okay? And so they can check it at, they can even do a physical count if they like, but you should be able to know how much inventory you have at all times, okay? And with this one though, one big difference is that once you make a purchase of perpetual inventory, it's going to be automatically recognized as inventory, okay? So once again, we will dive into this section when we come back from the exam, okay? So once again, but you just need to know the difference between periodic and perpetual, right? Periodic means every once in a while. Perpetual means you do it constantly, okay? Other factors is that you need to understand that periodic, you need to recognize your inventory as an expense, and at the end of the given period, you're going to create a conversion entry, okay? Whereas perpetual, I'll show you what happens later on. Okay, so once again, periodic inventory. When we make purchases, we're going to be utilizing only two key accounts: purchase expense and freight expense, right? Purchase expense is going to be in detail from your selling, from the actual purchase price that you actually purchased the items at. So this is what the person is selling them the items to you for, right? Any extra additional cost, such as freight and shipping, is going to be separated from the actual selling price or purchase price, excuse me. So that's why we're going to be having two accounts, all right? Now, just exactly like we do this when we journalize a purchase, we're going to recognize first what was our purchase price, or what did we purchase the items for. So in this case, we purchased 100 items at $5.65. So boom, it should be $565. And then we recognize freight. Freight was $100. And whether you either paid on an account or you paid with cash, right? In this case, I paid on an account. I'm going to recognize my accounts payable for the full amount, right? Because yes.
Lynn, can you zoom in on the slideshow a little bit?
Zoom in.
So we could see it more clear?
How is your right, I was gonna say you may have to fix your screen, so let me just pause this real quick. So go ahead and change your layout on your screen real quick. Once again, when we're making purchases of inventory, we're going to recognize our purchase expense, freight expense, right? They're two separate costs, and we're going to add them all together in our accounts payable, okay? So that's how you journalize this, okay? And then we have a purchase discount, right? Every purchase that we make, right? We also need to assume that will there be a purchase discounts or available, right? So typically,
I'm not seeing that screen.
you're not seeing the screen anymore?
No. Well, I see the screen, but what's on it says accounting chapter 5.1.
Yeah, you froze again.
My morning class just goes through pretty quick, smoothly. Okay. Okay, perfect. Perfect, okay. Okay, so here, terms, right? It's things that a vendor could give us, right? They could give us a discount because ultimately they're giving us an incentive too. Hey, I'll give you a discount, but you got to pay me, okay? You got to pay me within 15 days and I'll grant you the discount. So oftentimes, your vendors will give you incentives because, again, if you're buying in bulk from them, they kind of want their money back. They kind of want their money as soon as possible. So they'll do anything to give you some kind of incentive to, get their money back, but grant you a discount at the same time. So this is an example, right? And we see terms apply to customers as well, right? We could give our customers terms just as well as too. Okay, so just understand that this right here is that we need to understand that we'll take a 2% discount if you pay within 15 days. If not, the whole thing is due on 30. Okay?
So with every company,
Absolutely.
numbers will fluctuate depending on
Correct. Some of them won't even give you a discount. They'll just say it's due in 30 days, net 30. Some companies can grant you up to 10%, right? 5%, 1%, this number will fluctuate, yes, depending on who the vendor is. But most cases, you'll see anywhere from 1 to 5 or 10%. Depending on how generous they are to us. Okay. So once again, when we're looking at purchase discounts, right, we need to recognize that there are two different methods, right? We have the net method and the gross method, right? Best way to understand that is net method means you're going to take the discount now, okay? Where the gross method is where you just record it, and then when you eventually pay for it, then you take the discount later. Most cases for businesses, especially small businesses who don't generate money as quickly, your best bet is that you want to use the gross method. Now, if you've been a long going running company and you're good at paying your bills on time, then net method should be, should be available to you. You're allowed to use it. So once again, net method is for people who pay their bills on time, or who keep track of their bills really good, really well, or if they make a purchase, they know they're going to pay within 3 days, right? That means they have a lot of money. Whereas gross method, right? You have other priorities that come first. So maybe paying off your purchases of inventory isn't your first priority, right? Maybe you have to pay rent, you have to pay utilities, all those extra expenses you may have to prioritize and pay those off first, and maybe this must be on the back burner, right? So usually these are the two methods that you can journalize, right? So I'm going to show you the gross method first, right? If you guys remember, when we do the gross method, right? Here we're giving a scenario. The company that sold us these mugs decided to give us a term of 5% 10, net 30, right? They're only giving me 10 days to pay back the cash. If not, the whole bill is due in 30 days. Okay, so first I'm going to recognize this. I'm going to recognize that I made the purchase in the first place, right? Now I owe them money. Okay, I owe them $225. Now let's say scenario 1 is I actually do pay them within the discount period. So I paid them within the first 9 days, right? So I purchased on the first, now I'm paying them on the 9th. I made the discount period. So how am I going to recognize this? That I'm going to recognize what I owe them. However, I'm going to recognize that I received a discount, and I'm not going to pay them for the full amount. I'm paying them less. Okay? So this only happens when you decide to pay. All right? So that's the difference between recognizing, when you recognize the discount, right? You only recognize it the day that you pay it. Okay? All right? Now, of course, scenario number 2 says that what if I decided to pay later and I missed the discount period? Then you just pay them for what you owe them. Exactly the $225. You pay them for the full amount, because at the end of the day, you're going to have to pay them regardless within 30 days. So whether you pay 15 days later, 16 days later, 20 days later, you still at the end of the day must pay them back within those 30 days. The full amount. Okay? So there you go. All right? Now let's check the difference out between the gross and the net method, right? This time, the vendor, right, they still gave you the terms, right? They still gave you terms 5%, 10, net 30, okay? But in this case, I'm saying I'm going to make sure I pay them within a couple days that I receive the inventory, right? The minute I receive the bill, I'm going to say I'm going to pay them off soon. So with that kind of mentality, right, instead of having to journalize my purchase discount, I'm going to assume I made my discount already. I know I'm going to pay it, so I don't need to calculate another journal recognizing my discount. I'm just going to take it off immediately. So in this case, I'm recognizing my purchase expense at the discounted price. Okay? Shipping obviously doesn't get a discount. So here, I'm recognizing that I am going to owe them $218 because I've already took the discount automatically out. Okay? So then when the day comes, right, the 9th, I pay them for my amount of $218. because I've already taken the discount out. I don't need to create another extra account to recognize the discount. I already took it out. Okay? But if I completely forgot about the bill and I end up missing the pay period, the discount period, then I'm going to have to recognize that I lost that discount. But because I lost that discount, I have to pay them for the full amount, which in my books, I discounted my items already. So I need to add back the discount that I lost and pay them for the full amount that my bill originally was reflecting. Okay? So again, you may be asked to journalize a net or a gross question, so make sure that you are aware of that. So again, chapter review, right? We learned about what periodic inventory does, right? We learned that there's 2 different methods. We learned how to journalize it, okay? And we learned the difference between the net and the net and the gross method, okay? All right. Any questions for this section? Okay.
Good.
So, or we make purchases, our next assumption is that we also have the ability to return our items. Now, why do we return these items? Many reasons why. We don't like the product. It was damaged. It was defective, okay? Maybe there was a cheaper vendor out there, right? If, that's completely fine, right? If you find someone who could sell the same exact product with the same quality, but for a cheaper price, I'm going to take that option, right? Because the whole point of doing business is to lower all your costs and maximize your profits. So if you can go to someone else who can sell you the items a lot cheaper, do it, right? Many other reasons too. Even if poor customer service, right? If this vendor decides to just keep sending you all the wrong stuff and you've had enough of their poor service and they're not handling it very well, you could also say goodbye to that company and be like, I don't like you. All right? There's many, many reasons to why we have returns and allowances, okay? Now, of course, as a manufacturer standpoint, right? Because you're probably going to be one of the people who, they sell a lot of items at you. They sell you in bulk. They want to keep your, they want to keep you as a customer, right? Because you make up a large portion of their profits or whatever it is, right? You make up a huge portion of why they sell out their inventory. So with that being said, they can grant you many things. They can grant you unlimited returns and refunds. They'll give you your money back guarantee. They can even give you special offers, right? Hey, if you shop now, I'll give you a special code for just you and you only to take 15% off of anything that you want to purchase, right? They'll give you any promotional deals because they want to prize you as a loyal customer, right? So they have all those things. But you also have to keep in mind that, you don't want to take advantage of your vendor either, okay? So with that being said, first thing we're going to do is let's go ahead and recognize that we're going to make a purchase in the first place. We need to purchase something in order to be able to return something, okay? Common sense, but yes, you must make a purchase before you can return anything. So here, I recognize that I purchased my items, right? It's the same scenario, right? I purchased 100 coffee mugs at $5 in 85 cents. Oh, sorry, $1.25, my bad. So we purchased the items at $1.25, okay? Here, I recognize that I owe Cuppy's Co. Okay. Now, let's say I received a shipment, but in this case, I found that 10 of those mugs were broken, right? It's useless to you because you can't sell it. And it's useless to the vendor too, because even if you ship them back their broken mugs, what can they do with it? Right? So here the vendor is going to grant you a full refund, because especially if you're purchasing coffee mugs, right? The vendor sold you damaged goods. So, that's definitely reasonable to give you a full refund. So in this case, what are we going to recognize? The way that we paid it, right? We placed it on an account. We didn't technically pay for it yet, but they charged us. Okay? They charged us on an account. So in this case, we need to reduce that amount, right? Or in a sense, refund the money and credit it back to your account. So we're going to reduce the liability that we owe them. Okay? And then second here is we're going to recognize the purchase returns and allowances. We need to recognize the contra account. Okay? So this purchase returns and allowances is a contra account to the purchase expense account. And the only rule here is that we can only refund for the original selling price. No tax. You cannot refund tax. You cannot refund shipping. You cannot refund any of those extra expenses. The only return that you can get is just on that selling price. Okay? So in this case, I got a refund for the 10 mugs at $1.25, which gave me a total of $12.50. Okay? Now, what happens if you receive the items, but they ended up being the wrong color or the wrong size? Okay? So in this case, I received extra large cups when I didn't need the extra large cups. I just needed the regular sized cups, right? Here, the vendor can do many things with you. They can give you the option to either give you a credit, they can either give you a refund, or they can apply it to another invoice, or, in other words, they want to still try to keep your business. So in this case, they can also give you a special discount offer because they need to find some kind of way to make up for their mistake, right? They're the one who shipped you the wrong items, right? They made a mistake, all right? And what they're going to do is they're going to try to look past it saying, I'm sorry, you know what? I can either grant you a full refund or, these cups, you can still sell them at your store. They're just large cups, right? So what they're going to do is they could convince you that, hey, keep the cups. We'll give you additional, 15% discount or 20% discount because we made a mistake. We sent you the wrong cups. So we'll give you a discount off of these. Okay? And you have the choice to whether you're willing to accept it or you're just willing to accept the full refund. It really depends. Okay? Now, in this case, they offered you a 20% discount off of the 25 mugs that they originally sold. They originally sold to you, but they were the wrong size, okay? So remember that you're not going to be discounted off of the entire bill. You're only going to be discounted off of the portion that was incorrect, the order that was incorrect. So in this case, I'm only looking at my 25 mugs, okay? And I'm going to get a 20% discount off of those 25 mugs. So in this case, this is what an allowance is. So an allowance could be, in other words, like a credit, okay? You're not going to get the full money back, but you are going to be getting some kind of credit back, okay? But in accounting, it's going to be considered an allowance, right? So then here, once again, how did we pay for it? We paid it on an account. So we're going to reduce the account. Reduce the amount that they owe you, right? Essentially give your account a credit back. You're going to recognize the purchase returns and allowances. So once again, the first example was a purchase returns. The second example is now a purchase allowance, okay? They function similarly or almost identical. So that's why we just put them together, okay? So purchase returns and allowances, because essentially you're attempting to return, but you're not getting the full money back. You're just getting your allowance. Okay? So here we're going to calculate the 25 cups, right, at $1.25, which gives you a total of $31.25. We're going to take the discount offer, which is 20%, off of the $31.25 to give you an allowance of $6.25. So that's how we deal with a purchase returns and a purchase allowance. Okay? We need to recognize that we have to create a contra account because this goes against your purchase expenses. Okay? So then, once again, chapter review, here we are, right? What happens when we need to return an item? Okay, one of them is for a full refund and the other one is for a discounted price. Okay. All right, so any questions there? Okay. Last but not least, the costing methods. Now, I'm not going to go through every single one on the PowerPoint because we're going to do it together in class. So for this one, I'm only going to go to the review part.
5.2.
Yes, because 5.3 was, learning FIFO. 5.4 is learning FIFO or LIFO. And then 5.5 is, yeah. And we're going to skip all of that because we're going to do it together anyway. Okay? So here, I just wanted to get to the chapter review section here. Just because, once again, we are going to do this. So this review right here pretty much just gives you a summary of what we've learned, right? We will learn, or what we have learned, excuse me. So again, when we think about FIFO, FIFO means first in, first out. So anything that we purchase, right, it's always we're going to start from the top and make our way down to the bottom, right? That's how we calculate our cost of goods sold. We're going to start from the top and make our way down to the bottom first, okay? LIFO acts as the same as FIFO, except instead of going from the top and making your way down to the bottom, you're going to start from your last batch and make your way up to the top, okay? And then again, weighted average. Weighted average, we don't care what came first. We don't care what came last. All we care about is what was our total amount that we purchased, what was the total cost, and evenly distribute the total cost amongst your total quantity. And we're going to get what's called an average cost per item, and that is what we care about, okay? So that's what I just wanted to make sure that you guys kind of understood in this part, but we will go over an example of every single one, okay? And that's pretty much all I wanted to say from chapter FIFO, LIFO, and weighted average, okay? All right, so the last chapter that we have is chapter 6, okay? So chapter 6 here, right, is dealing with periodic purchases, right? Purchasing inventory. Now, this is what happens when we have to deal with actually encountering the sales, right? So once again, sales is pretty straightforward, right? My screen is frozen, okay.
Excuse me.
Can you still see my screen now? Okay.
She was going on, and I'm like, where are we seeing this on this?
I kind of knew, and I was trying to find a way to break in.
Okay, so once again, we are dealing with periodic sales, right? So again, the nature of a business, right? Pretty straightforward. We sell our items in hopes to make a profit, okay? So therefore, we need to calculate our cost of goods sold, and we need to create some kind of selling price that allows us to cover our costs, but also gain a certain percentage of profit, okay? So once again, you're not responsible to create this selling price. That's going to be for the profit managers. But just knowing that the selling price is going to be consisting of those two factors, right? The cost of goods sold, so as long as you cover your cost and then make some money on top of that. All right? We also have to assume that if we're selling our products, right, we need to charge sales tax. So once again, here we're at, right? If we sold our product, right, in this case, we're going to sell our items at $9.99 each. Okay, so therefore, pretty straightforward. Okay, excuse me. I pressed the enter key. So here we're gonna recognize sales tax because we're assuming that we're in a store. We must charge sales tax. So we're gonna recognize first, how did we receive the money, right? If we're making a sale, our main goal is to receive money, right? So how did we get paid? Either cash or on an account. Straightforward. Okay? And then, of course, we got to take a look at sales, right? Sales is our revenue. It's the way that we generate, profits in our company. So we're going to recognize sales. And, of course, sales tax, right? We don't own the sales tax. It's owed to the government, but we're collecting it for them, okay? So here, sales tax payable is something that we're going to collect, but we don't own that money. It's something that we owe to the government. So there we are. Same thing here, right? We're going to recognize the first thing is, what is my actual sales, which is just the selling price itself multiplied by the units that were sold, right? And then from that price point, you're going to charge your tax based on whatever percentage you are, charging. So in this case, I want to make sure that for the rest of this class, we understand that we're just going to be using 8.25%, okay, for this class. So here, we just calculated right here that my total sales was $99.90, and my tax was $8.24. So therefore, I'm going to be receiving the full cash of $108.14. Okay? So with this kind of idea here, we're recognizing that my total sales in cash or whatever I received was for the $108.14. Okay? Then we are going to, understand that because with periodic inventory, right, we don't care to calculate or care to keep track of what we sold. Okay? In terms of updating the inventory, right? All we recognize here is that we sold 10 items. But I'm not going to update my inventory for that because what happens at the end of the given period, someone's going to go down to the basement and tell you how much you have left anyway. So your assumption there is then if all those items are missing, you must have sold them. Okay? Like I've mentioned before, it's not ideal, but for those kind of instances where you're selling something that doesn't sell very often, then you would definitely use the periodic inventory for that. Okay, so once again, that's it for sales. We only recognize the sales. We don't update our inventory at all. Okay, so that's it right there. Right? And of course, with sales, we have to assume that every sale that you make, you're going to have customers that want to return the items. Okay, and just like you return to your vendors, they can also have the same exact reasons to as well return their product, right? Especially if they just simply received it as a gift, they don't like it, they can return it, right? And yes, so with that being said, you need to make sure that you have some kind of company policy, because if you don't and you just let your customers return at any given time, then you defeat the purpose of having your business in the first place. Because if people can buy your stuff, use it, and return it to you at any given time, That's not very good for your business either. So you want to make sure that with this company policy, you want to keep the items that you sold, okay? You don't want your customers to come back and return them, okay? So with that being said, you can create whatever policy that helps you to retain the sales and make sure that it's sold. But you have to also know that if you do have those returns, you must return the sales tax. Okay? So for this example here, right? We sold to this customer, we sold 50 coffee mugs to them for $5 each, right? So we're going to recognize that we received cash. The sales were for the 500 cups, 50 cups for $5, excuse me. And we charged the sales tax. So we collected from them $270.62. Okay. So then what if the customer decides to come back and they say, hey, I want to return 10 of these cups because I don't like them. Simple. Or I don't want them anymore. Okay? So the company policy, again, you granted them full refund within 15 days. So how are we going to do it? Well, how did they first you got to recognize how many items are they returning? You can only return them for the selling price, okay? But you have to also assume that we got to give back their tax as well. And how did the customer pay us? They paid us with cash, then we'll grant them a cash. We'll give them back their cash, okay? Now, sometimes if a customer charged on our credit card, they can ask for cash instead of crediting it back to their account. If that is what they want, you can do that as well. Or for whatever means that they tried to get to refunding their money, whatever method they want to be refunded by, they may select as well. Okay, but in this case, we're keeping it simple. They paid in cash, we're going to give them back their cash. So through these, we got to recognize, how many cups did they return? They returned 10. How much did you originally charge for them? $5. Okay, well in this case, it's 5 times 10. Okay, and then we're going to give them their tax back, which is at $4.13, because it's going to be based off of the amount that we are refunding. Okay, so that's just the simplest way to calculate the tax. You can calculate how much tax that you were supposed to charge them and find the difference. But that's just, that's like 3 extra calculations you have to do when you can just simply calculate the tax based off of what you're refunding for. All right? It's a lot easier, simpler. Okay? So there we are. We're going to refund them for a total of $54.13. So we're going to refund them for the full amount of their the original price point, give them back their tax, and then give them their cash. Okay? Now, for small companies, you guys can haggle, all right? So, again, especially when you're dealing with customers that, they're getting upset or things like that, right? And you want to try to, make sure that your item is sold and you want to make sure that they come back to your store. You, as a small business owner, can take the initiative to give those little extra discounts, right? So for this example here, right, the person decided to return their items because they just simply didn't like the color. And you told them that they missed their company policy, right? They missed the date that they could return it for a full refund. So in this case, they're causing ruckus, and you want to make sure that you want to keep your customers satisfied. So what you do instead is you give them a discount, okay? Now, this isn't a discount, right? Don't confuse an actual sales discount. This is because it's on an individual basis, right? You don't give this discount to everybody. You're only giving this to this particular customer because they're attempting to return a product from you, okay? And you want to try to keep them satisfied you want to try to keep them satisfied. So you offer them a 15% discount off of what they're trying to attempt to return. Okay, so here we are, sales, returns, and allowances, right? Another contra account to sales, right? Sales is, it's finite, as in you can't change sales. Same thing to purchase expense. You can't change purchase expense. You can only create contra accounts to reduce them. So here you go, sales, returns, and allowances is a contra account, and you're going to reduce the amount. So they're trying to attempt to return 10 of those coffee mugs, and you're trying to reduce it by 20%. No, sorry, by 15%. Okay, so you're going to calculate the total amount there, right? You're going to calculate your total amount of returns, and then from there, you're going to calculate the tax off of that, because you have to give back their money, right? It's their money. It's not your money. So then you're going to give them back their cash afterwards. Okay? So pretty straightforward. Okay? And of course, we also have to consider that we can also give discounts as well, right? Most cases, what a sales discount does is it pretty much entices your customers to come into your store and take advantage of the discount. Now, most cases, if you are a consumer, like we all are, we're trying to find the best bang for our buck, right? We're not ever willing to pay full price for an item. We'll only buy it if it's on sale, okay? So that's why many companies are going to be willing to have these promotional sales, maybe offer this discount for this week, weekly ads, whatever it is, any way to bring the customer to the store and have your items sold, okay? So once again, we have two options, right? We can either do a store-wide sale, or we can actually grant our individual customers also sales as well too. So once again, when we're dealing with an in-store sale, right? Let's say the whole store is having 40% discount. Okay, so that means anything that anyone wants to purchase, it's fair game, right? Everyone is going to get the sales discount. So once again, sales discount is another contra account, right? It reduces the original selling price. Okay. However, how we calculate it or how we journalize it is that we got to recognize how we're going to get paid first. We're going to recognize what the discount is for. And then we're going to recognize what the original sales was. And of course, we need to also calculate the tax that is going to be involved with the sale itself. Okay? So once again, we're going to calculate first things first is what was my total sales in the first place? In this case, I sold a total of $100. But I have to discount it 40%. So therefore, I need to take away $40. So that means my total sales was for $60. I can only charge tax based on the actual amount that I actually sold. So in this case, I need to calculate my sales tax based on the $60 to get me a total of $4.95, which then I'm going to calculate in total how much cash I should be receiving. So I should be receiving $64.95 instead of the $100 that we originally sold it for, right? Because we granted the discount, we are only discounting the selling price. So basically what you're doing is you're just discounting the amount of profit. There is no way or nor correlation between taking the discount and discounting the actual cost of the product itself, okay? You're only taking discount off of the selling price, okay? So there it is, right? Pretty straightforward, right? if you go to any grocery stores and you do see that sales, read your receipt because you will see you getting charged for the actual full amount price. And then right under it, you see a line item that's going to tell you you got a discount on the sale item. And it's going to tell you what that discount was for. Okay. And then once again, when we are looking at giving our individual customers a discount, so like I've mentioned before, right? If a vendor can give me terms, I can give my customer terms as well. So in this case, this person came into the store and they wanted to buy something from us. And I said, hey, since you're buying in bulk, I can offer you a discount. But the catch is you have to pay me back as soon as possible. All right? And they're like, sure, but I don't have all my hats available here, so I'm going to charge you a $10 delivery fee. Okay? So here, I'm going to recognize this. They're going to place it on an account. Okay? They're going to owe me the money, right? And second thing is I need to recognize what my actual sale was, and I also need to charge the tax because if they bought it from the store, and I'm going to charge a separate little delivery fee, okay? So I'm going to recognize how much those hats were for 100 of those hats, right? For $10 each gives me $1,000 times the tax, which gives you $82.50 plus the $10 shipping is going to give you a total of $1092.50. Now with this though, they paid. If they pay within the discount period, right? Because I offered them a 5% discount as long as they pay within the first 15 days. If not, they got to pay me in full in 30. So in this case, they did pay me within the discount period. So this is where exactly just like my purchase discounts, right? This time I'm applying it as a sales discount. I'm going to recognize I'm going to be receiving cash because once again, for this one, this is terms. The condition here is in order for you to recognize the discount, the person needs to pay. Okay, if they don't pay, you can't take the discount. So here it is. I recognize that I'm going to be receiving cash. I'm going to recognize that there's a discount. I'm also going to recognize that I need to give back a portion of their money because if I'm discounting them right off, right, I originally charged them tax for items that they purchased, right? But in this case, I'm refunding a portion of the cash. So therefore, I need to also refund a portion of their tax. I need to give it back to them. And then I am going to reduce the accounts receivable because that's what they owed me, right? So in this case, since I never received the sales tax, I don't technically have to subtract out the sales tax. It's just because I journalized it that way. So even though I didn't physically collect the sales tax, that's what I have to do. I need to make sure I refund the sales tax. Okay. And then course review. So once again, here we are. We learned how to journalize our sales, right? We also learned about how to do a sales returns and allowances, right? We did a sales return. We also took a look at a sales allowance, okay? We also got to take a look at discounts, right? Whether it's an in-store discount or whether we give our customers terms, okay? Few little note here is make sure that you do not refund for shipping or discount shipping or tax, because those things are not applicable. You can only discount the original selling price. Okay? Let's see if we're good on time. Okay, good. So the last section I want to talk about is 6.4. So any questions? Okay. So last but not least, we're going to be looking at lower cost of market. So we've mentioned this very briefly, right, in the chapter 4, right, when we took a look at the historical cost. This is one of the exceptions to the historical cost principle, right? Inventory is going to be one of those items that can lose its value over time. And that's exactly what lower cost of market does. It allows you to adjust your inventory to the cost of the market. Okay? So again, usually this comes into play, especially when you purchase items, right? And a new model comes out. The item becomes obsolete, or they don't make it anymore, right? They stopped the line of production. So once you have those ideas, right? So that means as we move down in line and we purchase our inventory, we have to understand that the minute we purchase our inventory, that doesn't mean it's going to hold its value through the time. So for example, right, we use electronics, right? If I bought a 2018 laptop and I'm intentionally going to sell it, right, and it's 2018, but I didn't sell all of them out, I still have like 2 left over. It's fast forward 2021. Do you think I can still sell it for the same price? Absolutely not. Because, again, with technology, a newer model came out, right? We got the new 2021 Lenovo, whatever, right? You got a whole bunch of laptops that come out with better technology, better resolution, better memory, whatever it is, right? Because what we have to assume is that when technology advances, that means everything that's prior before it becomes obsolete. And it's going to be a lot harder to sell. And on top of that, we can't and it's not going to hold its value. It's not going to be the same as what you've purchased it originally, right? It's going to lose its value significantly. So that's why we need to calculate our lower cost of market. All right? So with that being said, we are introduced to 4 concepts, right? We have to know what the ceiling price. We have to know what the floor price is. We got to figure out what the market cost is. And then we got to figure out which one's lower, the original cost or the market cost. Okay? So once again, first things first is you should be given this information. And I will give you all this information, okay? You're not subject to purchase something and then fast forward later, I'm gonna give you all this, okay? The only columns that I need you to calculate is going to be the ceiling, floor, market, and lower cost of market, okay? All of these are going to be given. So here we have an example here. I originally purchased something that cost me $5.04, right? Fast forward, it's now the market is telling me that it's no longer worth $5.04. The market right now is telling me that it's worth $4.89, okay? But how I sell my price is that I choose that I'm going to sell it for $8.17. It's going to cost me 87 cents to get rid of that item. Whether it's to sell it out or if I were to purchase that item, it's going to cost me 87 cents. Okay? Again, the profit margin is not as important because you're going to be given the amount of profit anyway. This is just because with my selling price, I'm assuming that I want to at least get a 40% profit out of this. So if I originally purchased my item at $5.04 and I'm selling it at $8, I expect that I want to reach at least 40%. So I'm saying that means I need to gain a profit of at least $3.28. Okay? So first things first is step 1. We got to solve for our ceiling, okay? Our ceiling is going to be our selling price minus the cost of disposal. So in this case, I'm going to take my $8.17 and I'm going to subtract that $8.87, right? And that's going to give me my ceiling price of $7.30, okay? Then I need to, step number 2 is to solve for my floor. My floor is going to be my net realized value, which is the same thing as your ceiling price, right? It's your selling minus your cost of disposal. which I could just say is my ceiling price, and I'm going to subtract out my amount of profit. So in this case, I'm going to take my ceiling, I'm going to subtract out my $3.28, and I'm going to get a total of $4.02. That's my floor price. All right? Now, step 3 is to determine what the market value is. So in order to determine the market value, you're going to compare 3 numbers. You're going to compare your ceiling, you're going to compare your floor, so the 2 calculations you did before, and you're going to compare it to the replacement cost. Okay? So boom. Those 3 numbers are the only 3 numbers that you're comparing. Nothing else. Okay? And how do you compare it? You're going to put it on a number line. Place it in order from either highest to lowest or lowest to highest, right? You're going to put it in numerical value order. And how you're going to determine the market is simply which number falls into the middle. Okay? So here, my ceiling is $7.30. My floor is $4.02. So therefore, my middle number, which is my $4.89, which happens to be in the middle, is now my replacement cost. So by looking at my numbers, automatically I choose the one that's in the middle, which is my $4.89, and that becomes my market price. Okay? Now that I have my market price, I need to solve for the last question, which is, which one's lower? Your original cost or your market price? So, we're going to compare the 2. Which one's lower, or which one's lower? $5.02 or $4.89. In this case, my market price is lower. So that is my answer. My answer is that means I need to adjust my inventory to the market price. Okay? Which, here you go, is more examples. So again, we're going to go over an example in class. So we don't need to do that. And then, of course, I'm not going to test you on how to journalize it. This is more for extra information on what to do when you actually are in that position where you need to adjust your inventory. So in this case, I'm not going to go over it just because I'm not testing you on it. Okay? All right, and then the review, pretty straightforward, right? I give you the four things, right? 2 of them are calculations, 2 of them are just comparing the numbers. Okay? So, any questions in regards to Chapter 5 and Chapter 6? Okay.